a video guide to Falkland Islands Tax Residency for individuals. Every country in the world has its tax residency laws. They are often long and complicated and designed to ensure that those who live, work and do business in their country are paying tax where appropriate. The Falkland Islands has its own tax residency laws. It is important to remember that these are separate from the UK. The Falkland Islands tax residency laws primarily rely on days spent in the Falkland Islands. You therefore need to count how many days you spent in the Falkland Islands in the calendar year. The number of days spent in the Falkland Islands determines your tax residency status, and we will consider the variations now. If you spend 183 days or more in the Falkland Islands, you are considered tax resident for the entire year. Therefore, if you spend less than 183 days, you are taxed as non-resident. However, if you spend 45 days or fewer in the Falkland Islands, you are unlikely to need to pay tax at all. We will consider these in turn. If you are tax resident in the Falkland Islands, then you will be taxable on both your Falkland Islands income and your worldwide income. This includes interest, dividends, rental income and any other income you may have. You will get full access to the full personal allowance of £15,000. Regardless of how many days you actually spend in the Falkland Islands. You will also be entitled to all reliefs available, and you will be required to complete a tax return. If you are deemed to be a non-resident in the Falkland Islands, then you are only taxable on your Falkland Islands income. Your personal allowance is reduced in line with the number of days you are present in the Falkland Islands. You are also limited on the reliefs that can be claimed. You are not required to complete a tax return, although you may choose to do so. The 45-day limit, which is not taxable, works a little differently. You are largely exempt from the requirements to file and pay tax in the Falkland Islands if you're present for 45 days or fewer. However, this is not based on a calendar year. Instead, it refers to any 12-month period. If you make multiple trips, you need to look both forward and back to other visits to see if your days in the Falkland Islands are over 45 days in any 12-month period. Future visits may also bring earlier visits into charge. There are many reasons why you may stay longer in the Falkland Islands. Maybe to travel and see some of the beautiful landscapes or the unique wildlife. It's also not uncommon to get air travel delays or some other event outside your control. But remember, there are no exceptions to the calendar days rules. They are just that and set out in law. This makes them simple to follow, as we've already explained, but it does create rigidity that takes no account of individual circumstances. You may find yourself on a flight delay or sick, which increases your days through no fault of your own, but there is no flexibility in the rules for this kind of scenario. If you fail to meet the tax residency test, but are habitually resident in the Falkland Islands, you may be able to claim that you are ordinarily tax resident. The law surrounding being ordinarily tax resident is vague and open to interpretation of what a temporary absence means. Largely, it will rely on individual facts on a case-by-case basis. You should consider any claim carefully and seek appropriate advice before claiming this status, which allows you to be taxed as though you were tax resident. As you can probably gather, there are advantages and disadvantages to being tax resident or not, but it will largely depend on your personal circumstances. There are a few other issues you may wish to note. If you are UK tax resident, you may be covered by the Falkland Islands and UK Double Taxation Treaty, which tries to prevent you being taxed twice on the same income. It can be complicated to determine if the treaty applies, and, if it does, which country has the right to tax the income. So you should always seek advice before relying on any part of the treaty. Falkland Islands tax residency laws are entirely separate from any other rules you may come across regarding residency. Having a work permit, PRP or Falkland Islands status are not relevant for tax purposes. By the same token, being a Falkland Islands tax resident does not infer any other residency rights. And remember, there are no exceptions to the calendar days rules. This video guide has covered the Falkland Islands Tax Residency rules, but has not gone into detail into what your tax residency status may mean for you or your individual tax affairs. There are many tax rules and laws that determine the income you pay tax on and which reliefs you can claim. These are outside of the laws related to tax residency. It is important to consider all the tax legislation when considering your tax status in the Falkland Islands, so please get in touch if you have any queries. While the Falkland Islands tax system may seem unfamiliar, we are here to help. If you have any queries, questions, or require assistance with your tax affairs, contact Albatross Tax, the dedicated tax advisor for all Falkland Islands tax queries. Visit our website today.